All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we're joined with Joe Fairless, visionary, co-founder, and managing partner of Ashcroft Capital, 2.7 billion assets under management, and creator of the best real estate investing advice ever show and the world's longest-running daily real estate podcast. Is a celebrated investor, educator, and philanthropist, redefining multifamily excellence. Joe, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, sure. Well, looking forward to our conversation, Josh. A little bit about myself. I'm from Texas originally, moved to New York City right out of college and lived there for 10 years, was investing in single family homes in Texas while living in New York while I had my full-time job. I was making $30,000 out of college living in New York City, so that didn't go very far as you can imagine. And climbed the corporate ladder, saved up money, kept my living expenses really low, relatively speaking, for New York City standards, and saved money by 4 single-family homes while living in New York, bought them in Texas. And then while I had my full-time job in advertising, I started getting a lot of questions from my coworkers and friends. Hey, you have these homes. How are you doing that? Because you work with us. Like, how do you have time to do that? So I started teaching a class on it, and I did that on the weekends and in the evenings, along with babysitting actually on the weekends to earn some extra money. And I ended up uh, my boss, former boss, ended up attending that class, and he said, "You know what? Customers before I had a product, essentially. I had investors before I had an actual opportunity for them to invest in." So I started studying apartments, and then ended up getting my first one about 12 years ago, 168 unit, and then went from there.
That's massive. So we're going to have to rewind, because going from 4 units, 4 houses, 4 properties to 160 plus units, that is a massive leap, because you still have to build up your confidence in yourself, your confidence to be the operator, to raise the capital, to not only close but then to execute on the business plan. Tell us a little bit about that gap between the 4 properties and then what it took to actually get your first deal closed.
Yeah, it was that first prop, the big one. I was woefully underqualified with what the experience I needed to bring to the table. I now know, and I learned shortly after, or not shortly after closing, but throughout the ownership process. I I learned a lot of lessons on that deal, and there's a ton of them that I learned, but one of them that I took with me, that I immediately applied, is that I'm good at certain things and I'm not good at other things as it relates to what's required for the business. And for multifamily investing and apartment syndication, there are 3 components to the business. You need the equity, you need the money, the rate for the deal. You need 1, 2, you need the deal itself, and then 3, you need to operate. And I realized on that first deal, when I tried to do all 3 myself, that I wasn't setting things up for success, because I didn't have the decades of experience, asset management, underwriting deals, finding the right deals. So I ended up finding, business partner after that, and we formed my company with my business partner, co-founder Frank, and we formed Ashcroft Capital and skill sets, and that's been really helpful. But going from 4 single family units to 168 unit, I was really ignorant. I thought that it would, because 4 single family homes, they were remote, and I didn't have to do a whole lot because I had a property management company. So I thought, oh, okay, well, this property that I'm buying, it's got a property manager on site, so I really won't have to do much. not the case. I didn't underwrite it correctly, specifically deferred maintenance and the difference between economic and physical occupancy. Physical occupancy, number of people living there, economic to live there. And there was a big difference. And I learned that the hard way whenever we took over and whenever I was trying to turn the property around. And then deferred maintenance just didn't have enough in the budget initially to uh, address the deferred maintenance that there was. So, a lot of lessons that I learned on that to then apply to the future deals that we did since then.
Yeah, well, that's exactly how wisdom is built, is through experience and through the knowledge learned. And that's, you don't know what you don't know, and that's the biggest thing when you close on a property. Now you're starting to find out the bones of the property. What did the seller not tell you? What did he not find out on due diligence? And then having that cushion there to take care of the ifs and the what ifs, the unknowns. I know we're after broken, distressed, poorly ran properties, and um, I mean, I would say we're pretty good at turning them around at this point. But you go into your first one, and you just start you start taking your marks. Um, Start small and keep on building the
Yeah.
confidence up, and that's how you stay in the game. Um, tell us, you closed on it, you got in there, you started getting in the thick of it, and started working with property management and developing your business plan. What happens after you close?
Yeah, I mean, I was actively managing it along with the third party company that I hired to help me manage it. Uh, the first thing I realized is the difference between the physical and economic occupancy. So it was like 95% or so, I don't remember. It was in the high 90s occupied, but yet we were collecting 65% or so of the income. And
Hmm.
just realized that it was just a tenant base that wasn't reliable for paying their rent, and there were some units that uh, we didn't double check had been properly made ready before we closed. So it was just a lot of overhaul on the tour there, and I anticipated just cash flowing out of the gate and then using the money from the cash flow for the renovations, which that again lot of rookie mistakes that I made on that.
Got it. Well, now you all are up to 14,000 units, so far from 168. So tell us about the journey to get to 14,000, because with anything else, when you start to get economies of scale, new problems are created. So then you learn systems and economics and on and on and on. So tell us a little bit about the journey to 14,000, 14,000 plus.
Yeah, I was actually at one of our properties that's in Orlando. I was there this past Tuesday, and I was meeting with an investor, and he asked me about that. About how'd you get to 14,000, over 14,000 units, and the first answer that came to mind was partnerships. Partnerships with my business partner, partnerships with the employees that we have on our team, team members, uh, being able to scale because we have the right people in the right place, finding the right people, managing. We just implemented EOS, the book Traction. I read last year and I loved it so much. Implemented it for my business unit at Ashcroft, and partnerships with investors. Obviously, without our investors, you know, we wouldn't exist. Thinking about them and partnerships with. We used to have third party property management but now we have our own management company, Birchstone Residential, over 300 employees at Birchstone Residential, and partnerships with vendors. So it's about relationships. Like I'm a I I love to think about things in for the long term. So long-term relationships with long-term people. That's how I approach. And when we approach it as though, Tony Robbins would say, treat it like a beginning and there won't be an end, right? Like if we approach it that this is a long-term relationship with someone, whether it's an employee, whether it's a business partner, whether it's a resident, then generally more good things than bad things will happen. And that relationship with our spouse, right? Like treat it like the beginning and there won't be an end. So um, that's that thought process, that mentality is something that I've cultivated. And maybe I've had in the back of my mind at the beginning of my entrepreneurial journey. It's certainly at the and acting on it. So it's the partnerships all along the way. When Frank and I did our first couple deals, we didn't have a balance sheet. We didn't have the track record. So it was partnering with a property management company that had the background, had the track record, and had the balance sheet. And then we did 2 or 3 deals with them, and then we could go off on our own, third party management, whatever it was, and then we created our own management company. So it's evolving as we go through the different stages, treating people the right way all along the way, or attempting to, doing our best. There will be disagreements, but doing our best to treat people the right way all along the way, and treating it like the beginning, like so then.
Yeah, for sure. What year did you all close on the 168 unit?
Well, just to be clear, I did that by myself before I met my business partner. So he
Okay,
he
that was
wasn't
solely
involved,
you.
and then I learned the lessons, and then after that, I realized I can't do this on my own. So then I met my business partner, and we formed Ashcroft. So I did the 168 unit in July of 2013. That's when
Got it.
it was technically a master lease with option to purchase, where we were the
That's cool.
lessee. And then the first Ashcroft deal was August of 2015. So
So you
about
got
10,
into
a little
creative
over 10
finance.
years.
You did a creative finance deal out of the gates, though.
Yeah, yeah, master lease with option to purchase. It was the only way I could have got it done,
Yeah.
because I didn't have the balance sheet for 168 unit. I couldn't raise all the money that was needed for the down payment on a loan. So just became the lessee on a master lease with option to purchase, and the lessor was also the current owner, and the loan stayed in place, and we just came in and took on management abilities, and I was overseeing the management and everything from making sure the mortgage was paid to insurance payments to maintenance at the property, everything.
Yeah, it was your baby at that point. I mean, it was all you, just in a different way the paper was arranged. Out of curiosity, because we're in 2025 now, what was the price per unit then?
Well, it was one.
I
Let
would
me do
assume it's
that math.
substantially better than it is now.
Yeah, so it's 1973 property. 116, $30,000 a door,
Man,
and
what
I
anyone would
know
give.
they turned down about 6 years after we exited, maybe more, maybe like 15. Maybe we exited. They turned down $120,000 a door.
That's wild. That is incredible.
I don't know what it
You
would go
got it at
for
a
now.
hell of a buy price. Yeah,
Yeah, well,
that's
but it
wild.
lost
Just
money
the
because of my mismanagement and just n- not doing the mistakes that I made
yeah, you
on the
circled the wagons
property.
though. Circled the
So
wagons.
but learned a lot of lessons.
Yeah, well, you
Yep.
circled the wagons, learned your lessons, and continued on. I mean, clearly continued on in a big way. Um, I just out of curiosity, I was curious about the price per unit because we're seeing properties that shouldn't that just truly don't underwrite, but they're wanting upper 90s per unit in some areas, and in some parts of the country. I mean, you're at 150, 250,000. Just depends on the area, but again, it's what does the NOI support, and then after you close, does it support itself? Because going into negative cash flow after close, it could be daunting. So, tell us about some wins that you've had. Tell us about your underwriting deals, your finding deals. Tell us about some of the good deals that you've had.
The first deal that we did at Ashcroft, 250 unit in Houston, and we bought it for I think 14.1 or 16.1 million, and it appraised for 21.6 million about 15 months later, and we're able to do a refinance, get a chunk back to investors, and continue on. So that's very vivid in my mind because I knew that the business model worked. I just knew the execution of it needed to be better. And that was validation for me that yes, this is how things can work whenever you do things the right way. So that was our first property that we did, but it was something that's we've done anymore. I think we've sold um, 27 or so properties now, but that first one on that refinance, that was nice to have.
Confidence booster to go on and keep going, keep plowing down new territory. So where were you
That's
living
right.
at when you bought that and managed that property? Were you still in New York?
Cincinnati. And I was
Okay.
in New York, and then I actually moved to Cincinnati to manage the property in person. I lived in the model, and I would pack up all my stuff in the morning, walk to the leasing office, and then show the model unit to prospective renters. So I was very hands-on management. The uh, and then I met my wife, and who lived from Cincinnati in Cincinnati when I was. So then I moved to Cincinnati, and we've been married for eight or so years now. That first property that we did with Ashcroft, that I did under the Ashcroft umbrella, was in Houston, and I was still in Cincinnati. My business partner was in splitting. I don't know if he was splitting his time. I think he might have been just all in California at that time. Eventually, he's in Texas slash New York. So we were able to, as I mentioned earlier, we partnered with a property management company that had ownership in that deal, and they were local to Houston. So we were able to work with them, and they were on the ground, and they knew the market really well because they had a track record of deals there. And then that's a part of the business that I don't directly oversee. I'm not the asset management of the properties. It's my business partner Frank, because he's the decades of experience doing that. And that's what I've realized with any business, especially this one, is it's important to uh, partner with people who solve the void that you're looking to solve uh, without any coaching from you. Otherwise, you have an employee, not a partner. And a lot of people get that mixed up. A lot of people think, hey, you want to partner on something? Okay, yeah, I'm good at this. I just need someone who knows how to get deals in multifamily. Okay, great. Yeah, I used to work for a lender. So I can do that. No, that's not someone who worked for a lender getting deals. They were underwriting deals. They might have but they weren't the ones acting deals. If you bring in a partner, then that partner should be someone who has already got experience doing exactly what you are wanting them to do for the business partnership. And that's I see that mistake a lot when people start businesses and start companies, bringing in partners, but really they're bringing in an expensive intern or an employee.
Yeah. Yeah. And really, I mean, if you can divide and conquer where one's taking care of one piece of the business, hands off, taking care of everything, and then the other one's taking care of another piece. I mean, I think you get what your all's outcome is 14,000 units later. It's proof that you have the right people at the top and they're taking care of each segment of the business too. And then you've got your pillars, your people that are pillars below there that keep the company stood up. But it still takes competent, smart people to make that happen too. How are you
Yep.
all? Are you all using AI to help scale, help efficiencies, help get rid of some slack, some waste?
Yes. With you know, investor calls, we certainly do help grade our IR team members on how well they do on any of the investor calls that are recorded. We have, you know, a system that is grades them, and then we have plus deals that our IR team has to be knowledgeable of. We get an investor call asking about any of those 40 deals. So we have begun to have deals, a deal information uploaded into Chat GPT, and then that information from historical information to each monthly update is then uploaded in there, so that if someone's on a call with an investor, they can just type in the question. You've got all the information at your fingertips on that particular deal. Number of units, where is it at? What's the latest occupancy? What's the plan moving forward with it? Whatever it is. It's not a perfect system. The guy tends to hallucinate and make things up sometimes, but it's better than what we had before, where you're bumbling through spreadsheets and you're trying to all this different information. So much easier whenever you have someone a robot who is essentially just giving you customized information based on what you're asking. So that's been really helpful as well. And AI is something that I'm a student of, and it's a big focus of mine to continue to learn. I started a how-to AI show on my podcast selfishly just so I could learn more about it and what people
Yeah.
are doing, so that I can stay up to speed and so my team can stay up to speed. So that is a big focus of ours. And if you're not using AI right now, you're missing out on a competitive advantage, because there are others who are also not using AI. And right now, it's my opinion that we're in a Last Samurai moment. The Last
Yeah.
Samurai with Tom Cruise, that movie.
Yeah.
You did remember
Yeah. I
when
agree.
they had the machine guns against the swords? Sometime in the middle of the movie where a bunch of samurais are up against these like machine guns. It's like that, where if you're not using AI, you got a samurai sword, but you're up against a machine gun with people who are using it. And this is the time, because in 3-4 years, you won't have a choice but to use AI.
Hmm.
So you will be, if you're not right now. But right now, it's early, generally speaking, for integration companies. And this is a time we can get that big competitive advantage.
Yeah, we're in 4 years, it's going to be interesting to see what the landscape looks like. And I don't know. I'm not convinced it's going to add jobs. I'm not convinced it's going to take jobs. Well, I know it's going to take jobs, but to scale, I know Amazon announced cuts just the day before yesterday, and other companies, but I just don't know what that looks like for the buying power of the consumer when you start to see this thing really go into effect. So it's almost like I know I've put our rent roll in and have done some analysis on where the properties are at, the rent roll and jobs and everything else, and it's just getting ahead of what possibly could happen. If nothing happens, great, you're positioned better. But just what does the curve look like? Because there is going to be a curve. There's going to be people need to skill up and learn, because AI won't take the job from you. It'll take the job from people who aren't using AI, is what they say, which is a great analogy. But how big and how deep does it go? Because on the other end, every major corporation is racing to create efficiencies, which ultimately result in saving money from the overhead. So we'll see. But very cool. For the real estate investors that they want to get into real estate, they don't know how. They're tuning into your podcast, they're tuning in here, they're listening, they're scratching for information. How would you suggest that they start their journey to learn about real estate, get into it, and specifically multifamily?
Well, I'd say I've got I've got a book that I recommend. It's life experiences doing just said. So it's Best Ever Apartment Syndication book, and just look it up on Amazon and reviews. And if you're wanting to do apartment investing, if you're wanting do syndication step.
Yeah, give the basics, the lingo, learning the language, learning how to speak to the brokers, the people involved. It's becoming knowledgeable, and that just doesn't happen overnight. And it's not the thing with real estate. People tune in and they see different people becoming different levels of success, but they don't see every waking moment that they were up, that they're grinding to get to where they're at now. So it's real estate's definitely not a quick get rich quick or get wealthy quick deal. You have to show up, put in the education, put in the work, and just get involved too. Joe, if somebody wants to get a hold of you, reach out, learn more about yourself, possibly invest in any of your upcoming deals, how can they get a hold of you?
You can go to ashcroftcapital.com.
That's simple and easy. Like it. Very good. Joe, we definitely appreciate you coming on the show. Definitely look forward to continue following you, and appreciate your time. Thank you.
Enjoy the conversation, Josh.